By the end of this video, you will know exactly which investment vehicle is right for your specific situation, how to avoid the hidden fees that silently drain thousands from your retirement accounts, and you will have a step-by-step plan you can start today with as little as $50. I am about to break down one of the most confusing debates in personal finance, and I promise you, the answer is not what most people expect. Here is something that might shock you. Over 90% of actively managed funds fail to beat a simple index fund over a 15-year period. 90%. That means all those fancy Wall Street managers with their expensive suits and complex algorithms lose to a strategy you can set up from your couch in about 10 minutes. But here is where it gets interesting. There is one specific strategy that most financial advisors never tell their clients because it does not make them money, a strategy that can shave years off your wealth-building journey and potentially add 6 figures to your retirement account. I am going to reveal exactly what that is at the end of this video, so make sure you stick around. Today, you are going to learn 3 things that took me years and thousands of dollars in mistakes to figure out. First, the real difference between index funds and ETFs that actually matters for your wallet. Second, the hidden cost most beginners never see until it is too late. And third, the exact criteria to use when choosing between them based on your specific financial situation. Quick, if you have ever felt overwhelmed trying to figure out where to put your hard-earned money, if you have ever stared at a brokerage account screen feeling completely lost, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who need this information. Let me paint a picture for you. You finally decided to start investing. You have heard everyone from your coworker to your uncle to every financial influencer online saying the same thing. Just buy index funds. It is the easiest way to build wealth. So you open a brokerage account, feeling proud of yourself for taking action? Then you type in S&P 500 and suddenly you are staring at dozens of options. VOO, SPY, FXAIX, IVV, SWPPX. Some say ETF, some say index fund, some say mutual fund. The expense ratios are different, the minimum investments are different, and you have no idea which one to pick. So what do? You close the browser tab and tell yourself you will figure it out later. Later turns into weeks, weeks turn into months, and every single day you delay, you are losing money. Not losing it in the traditional sense, but missing out on gains. If you invested $10,000 in a simple index fund 10 years ago, you would have roughly $32,000 today. Every month you wait costs you real money. Every year of hesitation could mean $50,000 or more missing from your retirement. I have seen people lose hundreds of thousands of dollars over their lifetime simply because they got paralyzed by confusion at this exact moment. But here is what nobody tells you. The difference between index funds and ETFs is actually much simpler than the financial industry wants you to believe. They benefit from your confusion. Confused investors pay for expensive advice. Confused investors buy complicated products with high fees. Today, we end that confusion for good. Let me start with the foundation because if you do not understand this, everything else falls apart. An index fund is simply a type of investment that tracks a specific market index, like the S&P 500, which represents the 500 largest companies in America. When you buy an index fund, you are essentially buying tiny pieces of all 500 companies at once. Apple, Microsoft, Amazon, all of them in one single purchase. Here is a concrete example. Let us say you invest $1,000 into an S&P 500 index fund. You now own approximately 0.001% of each of those 500 companies. When those companies grow, your investment grows. When they pay dividends, you receive dividends. It is that simple. The mistake 80% of people make is thinking they need to pick individual stocks to build wealth. They see headlines about someone making millions on a single stock and think that is the path. It is not. Study after study proves that broad market investing beats stock picking for the vast majority of investors over time. Here is your actionable fix. Stop trying to find the next Amazon. Start owning a piece of every potential Amazon through index investing. The real magic of index funds is not finding winners. It is never missing them. Now here is where it gets interesting, and this is the part most explanations skip. An ETF, which stands for Exchange Traded Fund, can also be an index fund. Wait, what? Yes, you heard that right. An ETF is just a wrapper, a structure for how the investment is packaged and sold. Think of it like this. You can buy orange juice in a carton or in a bottle. It is the same orange juice, just different packaging. Index funds can come in two packages, mutual fund structure or ETF structure. When most people say index fund versus ETF, what they really mean is index mutual fund versus index ETF. Both can track the exact same index and hold the exact same stocks. The difference is how you buy them and some technical details we will get into. Here is a specific example with real numbers. Vanguard offers the S&P 500 index as both a mutual fund called VFIX and an ETF called VOO. Both track the same index. Both have an expense ratio of 0.03%, but VFIX requires a $3,000 minimum investment, while VOO can be purchased for the price of a single share, currently around $500, or even less if your broker offers fractional shares. The mistake most people make here is thinking these are completely different investments. They are nearly identical twins, just wearing different outfits. Your fix is to stop getting hung up on the label and start looking at what the fund actually holds and what it costs. But here is what nobody tells you, and this is where your decision actually starts to matter. The way you buy these investments is completely different, and that affects when you should choose one over the other. Index mutual funds are bought directly from the fund company at the end of each trading day. You put in an order in the morning, and it executes at whatever the price is when the market closes at 4 p.m. Eastern. You can invest exact dollar amounts, so if you have exactly $200 to invest, you invest exactly $200. ETFs trade like stocks throughout the day. Prices change minute by minute. You typically have to buy whole shares unless your broker offers fractional shares, and you see the exact price before you buy. Here is a real-world scenario. Sarah has set up automatic investments of $500 every 2 weeks from her paycheck. She uses an index mutual fund because she can invest that exact amount automatically without worrying about share prices. Her coworker Mike prefers more control. He watches the market and likes buying during dips. He uses an ETF because he can execute trades instantly at a specific price. Neither is wrong. They just have different preferences. The mistake most people make is choosing based on what sounds more sophisticated instead of what matches their actual behavior. If you are a set-it-and-forget-it investor, mutual funds make automatic investing easier. If you want more control over exactly when and at what price you buy, ETFs give you that flexibility. Stop. Before I continue, this next part is critical because it is where real money is either made or lost. Let us talk about expense ratios, the silent wealth killer that most beginners completely ignore. An expense ratio is the annual fee you pay just for owning the fund, expressed as a percentage of your investment. It gets deducted automatically so you never see it leave your account, which is exactly why it is so dangerous. Here are real numbers that should make you pay attention. The average actively managed mutual fund charges around 0.7% per year. A low-cost index fund or ETF charges around 0.03%. That is a difference of 0.67%. Sounds tiny, right? Let us do the math on a 30-year investment. If you invest $500 per month, earning 8% average returns, that seemingly small fee difference costs you over $200,000 by the time you retire. $200,000. Gone. Not because of bad investments, but because of fees you did not even notice. The mistake 80% of people make is never even checking the expense ratio before investing. They just pick whatever sounds familiar or whatever their bank offers. Your fix takes 30 seconds. Before you invest in anything, look up the expense ratio. If it is above 0.2% for an index fund, keep looking. There are plenty of options under 0.1%, and your future self will thank you for the extra $100,000. If you have made it this far, you are already ahead of 95% of people, and what I am about to share in this next section is the most valuable part of this entire video. Do not skip it. Subscribe to All Our Wealth Decode Plus if you have not already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Now let us talk about something called tax efficiency, and I need to pause here because this is where most people go wrong. ETFs generally have a structural advantage when it comes to taxes in regular brokerage accounts. Without getting too technical, ETFs can minimize capital gains distributions through something called the in-kind creation and redemption process. In plain English, you are less likely to get hit with an unexpected tax bill at the end of the year. Here is a real example. In 2021, many mutual fund holders received capital gains distributions even though they did not sell anything. They owed taxes on gains they never actually received in cash. Most ETF holders did not have this problem. Now here is the critical nuance. This only matters in taxable brokerage accounts. If you are investing inside a 401k, IRA, or Roth IRA, tax efficiency is irrelevant because those accounts are already tax-advantaged. The mistake I see constantly is people obsessing over ETF tax efficiency when all their investing happens inside retirement accounts where it does not matter at all. Your actionable fix is simple. Investing in retirement accounts? Pick whichever option has lower fees and easier automatic investment. Taxable brokerage account. ETFs get a slight edge for tax efficiency. This next section changed everything for me when I finally understood it. Let us talk about practical differences in trading and flexibility that affect your real-life experience as an investor. ETFs can be traded throughout the day, which sounds like an advantage until you realize it can become a disadvantage. The ability to trade anytime means the ability to make emotional decisions anytime. Market dropping? You can panic sell instantly. Stock soaring? You can FOMO buy at the peak. Mutual funds, with their end-of-day trading, build in a natural circuit breaker. You place an order, then you have hours before it executes, and you cannot change the price you get. Sometimes that friction protects you from yourself. Here is a specific example with numbers. During the March 2020 market crash, the S&P 500 dropped nearly 34% in about a month. Investors who panic sold their ETFs on March 23rd, the exact bottom, locked in those losses. Those with mutual funds who placed sell orders often had time to reconsider before the end-of-day execution. The market recovered over 100% in the following 18 months. The mistake most people make is thinking more control and more options are always better. In investing, sometimes constraints help you. Your fix is being honest with yourself. Are you likely to panic trade during market drops? A mutual fund structure might actually protect you from your worst instincts. But here is what nobody tells you about minimum investments and accessibility. And this has changed dramatically in just the last few years. Historically, index mutual funds required significant minimum investments, often $1,000 to $3,000. This created a real barrier for beginning investors. ETFs had no minimums since you just buy shares, but you needed enough for at least one share, typically $100 to $500. Today, the game has changed. Most major brokers now offer fractional shares, meaning you can buy a piece of an ETF for as little as $1. Fidelity even offers index funds with zero minimums and zero expense ratios, funds like FSROX and FZILX. Here is your specific takeaway with numbers. If you have less than $500 to start investing, a broker offering fractional ETF shares or a zero minimum index fund is your best path. Fidelity, Schwab, and many others offer these options. The mistake most beginners make is thinking they need to save up thousands before they can start investing. That thinking costs you months or years of compound growth. Your fix is to start with whatever you have, even if it is just $50. The habit of investing matters more than the amount when you are beginning. Let me give you your exact action plan because information without action is just entertainment. Here is what to do today, and this should take less than 10 minutes. Open a brokerage account if you do not have one. Fidelity, Schwab, and Vanguard are all excellent choices with no account fees. If you already have an account, log in and find one S&P 500 index fund or ETF with an expense ratio under 0.1%. Write down the ticker symbol. Here is what to do this week. Set up automatic investments, even if it is just $25 per paycheck. Most brokers let you automate this in about 5 minutes. If using a mutual fund, you can automate the exact dollar amount. If using an ETF, set up automatic fractional share purchases. Then forget it exists. Seriously, do not check it daily. Here is what to do this month. Review your 401k options at work. Most 401ks have limited choices, but almost all have at least one low-cost index option. Switch your contributions to the lowest fee broad market fund available. The specific tools I recommend are Fidelity or Schwab for brokerage accounts, the app Personal Capital, now called Empower, for tracking your overall net worth for free, and a simple spreadsheet to track your monthly contribution amounts. Now let me answer the question I planted at the beginning, the strategy most financial advisors will never tell you because it does not make them money. Here it is. The best investment strategy for most beginners is not choosing between index funds and ETFs. It is using both in a tax-optimized way. Put your ETFs in your taxable brokerage account for tax efficiency. Use index mutual funds in your 401k and IRA for easier automatic investing. Set it all on autopilot. Then literally ignore it for decades, while fees under 0.1% and broad market exposure do the heavy lifting. This is not exciting. It will never make headlines. But over a 30 or 40-year career, this simple approach will likely outperform 90% of professional money managers and active traders. That is the secret. Boring wins. Let me recap your 3 key takeaways. First, index funds and ETFs are often the same investments in different wrappers, so focus on expense ratios rather than labels. Second, ETFs offer more flexibility and tax efficiency in taxable accounts, while mutual funds make automatic investing easier in retirement accounts. Third, the best strategy is starting today with whatever amount you have, keeping fees below 0.1%, and automating everything so emotions never derail your progress. Comment below and tell me, which of these strategies are you going to try first? The automatic fractional investing, the tax-optimized dual account approach, or maybe finally starting that brokerage account you have been putting off? I read every single comment, and I will personally reply to as many as I can. In tomorrow's video, I am revealing the exact portfolio allocation strategy that millionaires use to protect their wealth while still growing it aggressively, something that took me years to figure out and most people never learn. Subscribe right now so you do not miss it.